Craig, welcome. So gold's up today. It had kind of been morose. It goes down $10. It goes up $10. Ping pong ball, kind of knife edge. And it looks like it's getting ready to do something. I'm not sure what, but what's your thoughts on it?
Well, Kerry, again, thank you for the invitation. It's always good to talk to you. As we speak here on May the 30th, it is I will call it the contract expiration day of the June gold on COMEX. That has been the front month for about the last 60 days. It's heading into its delivery phase beginning tomorrow. And so a lot of the action this week has all been bank shenanigans surrounding price. Not only with the contract going off the board today, but with options expiring back on Tuesday. I'll tell you one thing, Kerry. We can often anticipate where the options will price based upon the open interest. If you understand that the banks are the ones that issue the options, and they are the one that make the markets, and they are the ones that are actually on the financial hook to pay out cash to the options that finish in the money.
So they have to settle up, right? That's settlement.
Right. And so about a week before the options expire, you can typically look at the open interest of each contract, puts and calls, and pretty quickly decipher where you would have like a sweet spot for the banks, a spot for the banks, a price for the banks that would be the least financial pain when those go off the board. So Tuesday, the 21st, I actually record a podcast on my site. Because that was close enough. That was only 4 days away with the holiday back on Monday, where we said, somewhere between maybe 1275 to 1280 would be the spot. And on Thursday, price rallied up to 1285. And we thought, hey, well, maybe, because you can sometimes, of course, events get in the way and the banks can't manage it as well as they'd like. Maybe, one expiration out of four. But lo and behold, in the 10 minutes before the COMEX opened, before the open on Tuesday, gold gets hit for $6 or $7, trades down to 1276.
I'm shocked.
And then goes sideways the rest of the day.
Shocking.
It's just complicated stuff. All you have to do is understand that the banks are mostly in charge. And they are most of the time taking advantage of the speculator, hedge funds, trading funds, managed money, that kind of stuff. They do a lot of stuff by pre-programmed computer trading. So the banks know where the weak spots are. They know, if they can put price up against the moving average, stuff like that, they can get the speculators to do what they want them to do.
They paint the tape, right? That's what they do. That's what they're best at.
So we're getting to the point now, though, where, and particularly in silver, where all of those speculator hedge funds, managed money accounts have all been lured onto the short side, which makes the banks not necessarily net long, but some of them certainly are. We saw this happen, historically happen last fall. All the years I've been keeping track of this stuff, we've never seen the large speculators in silver get net short and the banks in silver get net long until one time in September of last year when we had washed all the way out through July and August into a low around $14. That almost happened again in November when we were back near $14. And then lo and behold, those speculators got squeezed out and price went to $16.20 in February. Well, here we are again. We bottomed out about $14.20 or $30 a couple of days ago. And those very same speculators have the very same, almost identical net short position. We'll get another commitment of traders report on Friday that will reveal this, I'm certain. And again, doesn't make it too complicated. We're already starting to see these little mini short squeezes develop like we've seen today. Price will soon be, the turn will be obvious to everyone. These shorts will get even more skittish, and we'll make a run to 15 and probably even then as we get into June because of the fireworks that are pending for June. We can talk about that in a second. Begin to make a run into the mid 15s and even 16. This is not complicated, like I keep saying. This is easily predictable if you know who runs these markets.
Yeah.
And sometimes you can actually make a fiat profit from it.
Yep. And then you can use that fiat to travel or buy bullion, right?
Or buy more physical metal. That's right.
I love it. I love it. So 15, 16, it's going to pop. It's been held in this holding pattern. And the market, look, I was just talking to David Morgan, our good friend, and the market is so puny. It is literally a fly speck on a horse's behind.
Right.
It's nothing. The market is, silver is nothing. Gold is substantial, but it is really, in the scheme of debt and everything else, a small market. But silver is puny. Platinum is nothing. Palladium is nothing. And all those other rare metals are nothing compared to the stock market, the currency market, and the bond market. They're nothing.
Right. At 14, let's just call it $14 to make it easy. And let's round up and say there's 1 billion ounces of silver floating around, because we mine. If you take out Russia and China out of the picture, because they don't really, Russia exports maybe a little bit of silver. World mine supply is 750 million ounces. But let's round up and call it 1 billion. And you've got a price of $14. I mean, the entire amount of above ground silver is only $14 billion. What's the dollar trading volume of Apple every day? You know,
I don't want to, whatever trading volume is now, because, Craig, those numbers have become meaningless, all of them, right?
Well, that's true. Yeah. Yeah. In the advent, in the age of everything being high frequency trading, you're absolutely right.
Yeah. I mean, and every number, the only number I can find that the government puts out, that anybody puts out, that I think is not rigged, is new claims for unemployment insurance, because nobody got around to rigging it or seasonally adjusting it or using harmonic, whatever they call it, balancing, hedonics on it. Hedonic, that's what it was. Hedonic adjustments. That's the only one that seems real, and that number is incredibly low, especially on a per capita basis, which is really the way it should be calculated, because that number has been going down. The number of people applying for unemployment insurance, with the exception of recessions, that number has historically been headed much lower. So I think it tells us something, but I'm not sure what. But anyway, so the metals, I mean, really, they're holding them in a pattern. And the other thing that they had, Craig, is seasonality here. This is a seasonally slow period for precious metals, and it's very easy to smack them down and to really move them quickly on relatively little volume, right?
Well, that's true too. Which, if the banks do want to squeeze some of those spec shorts in silver, it makes it very easy to do to allow that to happen.
Oh yeah.
Well, what's most compelling, I think, though, in the month of June, which is just about to begin, is this whole thesis you and I have been talking about all year, that 2019 looks a lot like 2010, is continuing to play out.
Yes.
It's quite clear that the U.S. economy is already slowing, and we haven't even really seen any impacts of this trade war yet. We're 2 months into the second quarter, and most all projections for second quarter GDP are in the 1 to 1.5% range, down from 3, which was kind of an inflation-adjusted joke in the first quarter. Mm-hmm. We are headed toward a negative print for the third quarter GDP. And if you remember, Kerry, no one will even call it a recession until you have 2 consecutive quarters, right?
Yeah. So we're safe till the election.
If we print negative in the third quarter, you're not going to get the fourth quarter negative print until February.
Yep.
So we could be in a recession or entering one right now, but yet, the NBC Nightly News isn't going to talk about it until February.
Correct.
So that's why you got to begin to anticipate these things. We know this is coming, if anything, just simply by looking at the bond market. The Federal Reserve, we've been saying for years, cannot raise interest rates. Now, they tried to raise the Fed funds rate, but the 10-year note only got to 3.25. I mean, this idea that there was going to be normalization of interest rates in the U.S. is a joke because of all the massive debts, both public and private, right?
They cannot do it.
That's been discovered now. And so now the 10-year note yield, think about this, Kerry, has gone from 3.25% in November to 2.25% today. And that is a huge move. And what it has done is it has inverted the yield curve, which for people that don't know what that means, the shorter term interest rates should be lower than long-term interest rates for a number of reasons. But right now, the shortest of interest rates, the Fed-controlled Fed funds rate, is higher than everything out to 10 years. In fact, even at 2 years, the 2-year note yields 2.10%. The effective federal funds rate is 2.4%. So the Fed actually has to cut the Fed funds rate by 50 basis points just simply to get a positive slope in that yield curve again. Get the Fed funds down to 190, the 2-year at 210, and the 10-year at 2.25. Ain't nobody out there, Kerry, talking about a 50 basis point rate cut. So therefore, this next FOMC meeting, which is 2 weeks from this coming Wednesday, it concludes on the, whatever that is, the 19th, I think, of June, 18th or 19th of June, is going to be quite consequential. Nobody's talking about even a 25 basis point rate cut from the Fed in 3 weeks. But man, if the stock market keeps melting down, not only knows what's going on with things like Deutsche Bank, if the bond market continues to rally as the way it has, the pressure is going to become overwhelming. And you're definitely, I mean, we're all right on the verge of at least a 25 basis point rate cut and all kinds of dovish language out of the Fed. And nobody trading gold and silver is anticipating that. And so entering into that seasonal period, you're talking about lighter volumes, smaller bid offer stacks. Things could get really volatile this summer, and volatile to the upside for once, which would catch a lot of people off guard.
Wow. And that's pretty interesting there, because it's totally a contrarian play that nobody's expecting here, Craig. No one's expecting it, right?
But the bond market's telling you. I mean, by every historical measure, if you invert out to 10 years, or really even, I've seen some stuff, if you just simply invert to 3 months, meaning that the Fed funds rate, the overnight rate, is higher than just a 3-month, 90-day T-bill. That is a guaranteed recession predictor. It happened in 2000. It happened again in 2007. And it is happening right now. The 2-month T-bill is, the 90-day T-bill is about 2.3, 2.35%. And again, the effective federal funds rate is 2.4. So everything is screaming pending recession, which means a reversal of Fed policy. They've already said they're not going to tighten anymore. They've also said they're going to start looking at, what the new neutral rate is, all this kind of stuff. And again, nobody, I mean, it's all staring you in the face, but
nobody sees
I guess
it coming.
Nobody wants to really pay attention.
Hey, nobody wants to admit the things that the hype, all of the propaganda isn't true, that this isn't the best economy of all time, for sure. I mean, nobody can deny that. Hey, just to pass along one anecdote to you, I needed to buy a lock set, and I went to Home Depot, and I wanted a cheap one, and the Chinese ones are this company, Kwikset, and they're about a third less than Schlage. I could not find one Kwikset lock set in Home Depot. They were all Schlage. So I said, all right, I guess I'm going to pay a third more. And then I looked at where Schlage is made. Schlage, old line, premier U.S. manufacturing company. They're made in Mexico. So Trump is making Mexico great again. That's what it comes down to, right?
Well, this would be a fun topic for another day, Kerry. To me, that's all related to the dollar reserve status, just like there is a petrodollar, this agreement Kissinger struck with the Saudis in 73 to provide a constant demand for dollars worldwide by pricing energy in dollars. There's also, let's call it an export dollar. I mean, there's a reason why our policies are structured that we send all these jobs worldwide, because it, again, creates an even more vast pool of dollar creditor nations that have to recycle those dollars back into our treasury market and keep demand for the dollar. It's all, to me, one massive scam that now we're to the point where the U.S. is using its superpower and empire status to almost be a financial bully. Terrorist is probably too strong, but we're a financial bully. Anybody that doesn't want to play ball, doesn't want to follow our lead geopolitically or economically? Would they get slapped with sanctions and threatened to cut off from SWIFT and the U.S. banking system and all this other stuff? And it is driving the world slowly, gradually, but inevitably toward an alternative structure.
And to the brink, too.
We are so arrogant. Our politicians are so arrogant that they think that the world will never change. This power we've had since 1945 is going to be with us for the next several centuries. And that's just not the way the world works. And it's just another reason why people need to be gradually, consistently, every single month, adding some physical precious metal to their stack, as part of their investment portfolio.
Yeah, I totally agree with you there. And we're entering a new kind of era, so you better be ready for it. And hey, that would be remarkable to see precious metals at this particular time of the year at their seasonal low point really spike higher. And of course, experts will be surprised, right? Experts are always surprised.
Right.
Experts never see the obvious coming. You ever notice that?
Well, and Kerry, when you and I did a webinar a couple of weeks ago, and for anybody that didn't see that, I'd encourage him to. You'll probably have a link to that you can post. But I would encourage people to check it out. And one of the, one of the charts that I posted for you was showing people how, if you can see this year unfolding as 2010 did. Remember, we entered into 2010, the economy was roaring, green shoots everywhere. The Fed QE1 was a one-off and all this kind of stuff, which is very similar to where we entered 2019. Oh, the Fed was in charge. They're going to be hiking rates. Everything's going back to normal, all this kind of stuff. Mm-hmm. You could have been completely right. Mm-hmm. If you thought by late 2010 that everything was going to be falling apart for the Fed and for the economy, and you could have been shaken out of your gold and silver by the action in the first half of 2010, because prices went sideways. In fact, between late June and late July of 2010, the price of gold fell by $100 from $1,260 to $1,160. And that could have shaken everybody out, even though you were dead right about where it was all headed. Because then, beginning in August, gold went from $1,160 to $1,420 and then continued on to $1,920 8 months later.
Yeah.
So I would encourage everybody to understand where this is headed. Again, this month is going to be June. This next Fed meeting is going to be a real doozy, and it's going to catch a lot of people by surprise. Just simply, the Fed at a minimum is going to be changing to pretty dovish language. And outside of that, I think for sure they're going to be cutting 25 basis points, if not June, by the next meeting in July. The bond market's going to force their hand. And as we've discussed, nobody is anticipating that. And that's why you'll get this, like you called it, almost contrarian rally that squeezes a lot of shorts in silver, pushes gold all the way back to the top of that range to at least 1360. And then we'll face a rather important moment in time.
Yeah, and it'll probably pull back. But hey,
it might.
You know what? It could go forward, but technically, it's probably not the time that it's going to do it. But I think it will test that resistance point again, maybe a couple more, 2-3 more times.
Yeah, it might. Yeah,
but
because when it does, it's clear to anyone that follows this stuff that any breakout above 1360, 70, something like that, you start putting a 14 on gold, you're going to get a wild surge of speculative momentum and that kind of stuff that's really going to put the banks on the heels. And so therefore the banks are going to try to keep that cap on there at 1360 real tight.
Yeah.
So it may take several more times to get through there. You're right. But the way the Fed policy is, the way the economy is trending, the global economy is trending, it's for once, it's going to be a losing fight for them.
Yeah, we know that. The handwriting is on the wall. Well, anyway, Craig, it's always great having you here. Make sure you go check out Craig's site, tfmetallsreport.com. We got a special offer there for you. And hey, our Twitter feed is at Kerry Lutz. Email us, kl@kerrylutz.com. Questions, comments. Don't tell me that we're like the stop clock people. We're right twice a day. This is a lot more. It's a lot more complex. It's a lot more, I guess you would say, profound than that. Because it's not like, it's not like, you're a regular clock and you're off a tenth of a second and you're only right once every 12,000 years here. We're not talking about that. This is way more.
If I might just add real quick here, I
Sure.
get people bitching all the time and trolls on the internet and stuff
trolls,
because gold and silver have gone sideways for the last 6 years, or they're down versus 2011. Obviously, silver is too. But the reasons people bought this stuff in the first place have never been fixed.
Yeah.
You know, you just got to have a little longer term time frame. And nobody that I know of, at least, was telling people in 2011 to take all your money and buy gold and silver. Only a fool would do that with any investment.
Mm-hmm.
And so you just got to, you have to keep a long-term perspective and remember why you bought that metal in the first place. And as this all inevitably begins to now shake out and the central bankers are exposed, it's about to get really exciting again. And people need to be prepared for that.
Yeah, I think that's a great point. So